Well, thank you all for joining. My name is Miguel Schwaizer. I'm the co-founder and chief risk officer of Quantia Capital, a cryptocurrency hedge fund and digital asset management company. I co-founded Quantia Capital early 2015, and my role at the company is to assess risk and minimize risk of our hedge fund, where we manage not only Bitcoins and USDT from ourselves, but also from different investors, companies, and funds all over Latin America. Our fund provides investment solutions for retail investors as well as institutional investors with basically two products. One is our arbitrage fund, which we started operating in early 2015, and we are now operating as a closed-end fund, as we have reached the optimum capital level for the strategy. And the second one is a fixed interest product aimed at retail investors that want to invest on crypto without the risk of losing their crypto assets. So since the beginning, we only focused on crypto, mainly in Bitcoin, as we believe that in the upcoming years or decades, if I'm pessimistic, we will see a significant inflow of capital from traditional markets towards Bitcoin and other cryptocurrencies, but mainly Bitcoin, as it occupies a very important monetary role, especially in the current context where all fiat currencies are being debased by their own central banks after the COVID crisis. But before going through the COVID crisis, I want to and point out some similarities between this financial crisis and the 2008 financial crisis, which was at the moment the biggest one in history, and was the one that gave birth to Bitcoin. So Bitcoin was born as a new asset class, and after the financial crisis of 2008, and it ended up being a completely new asset class, absolutely uncorrelated with the traditional markets. So after many attempts by different people to create digital currency, Satoshi was the one who successfully solved the that existed in previous systems, making Bitcoin the only truly decentralized, immutable, and trustless protocol. And this is not a minor feature, as at the time trust on the financial system was completely broken. And why? Because at the moment, credit rating agencies that were responsible for rating mortgage-backed securities turned a blind eye and gave AAA ratings to securities that were 80% AAA and 20% garbage. So trust was completely broken. And why did they do this? Because better ratings meant more mortgage loans, more profits for the banks, and more fees collected. So that in the end was materialized as $1 million bonuses for top bank executives. But eventually these high leveraged bets by the banks didn't end well, and the whole system collapsed like a domino, leaving us in what it was until this year the worst financial crisis of all times. This resulted in Lehman Brothers, one of the world's biggest financial institutions, going bankrupt, and many others be bailed out by the US federal government, which had to inject more than 700 billions into banks that were too big to fail. So this was the front cover of the Times newspaper in January the 3rd, 2009, the day the Genesis block was mined. And block 0, or the Genesis block as we call it, has a message which represents a possible reminder of why Bitcoin was created in the first place. And the message reads as the Times cover on that day, and it says, the Times, January the 3rd, 2000, on brink of second bailout for banks. That year, the Fed had to print more than $700 billion out of thin air, debasing the US dollar and taking purchasing power away from the savers in that currency in order to save banks that paid millions of dollars in bonuses to top executives that didn't do their job as they should have. So in order to put it in perspective, the bailout size of 2008 was way bigger than the current market cap of Bitcoin today. Today, the market cap of Bitcoin is around $165 billion, and the bailout at the time was around $700 billion. So this would be more than four times the market capitalization of Bitcoin today. And it took more than 10 years for Bitcoin to grow a market capitalization of 165 billion. And it took only a couple of months for the Fed to print this amount of money out of thin air. So is this crisis different? Is it the same? Well, this time is basically the same. There's no difference. And the COVID crisis is exposing the same problems with the current financial system. So biggest US 26% of their free cash flow on buying their own shares. So what does this mean? What are share buybacks? So stock buybacks refer to the repurchasing of shares by the company that issued them. And a buyback occurs when the issuing company pays shareholders the market value per share and reabsorbs that portion of ownership that was previously distributed among public and private investors. And why would they do this? Well, naturally, shareholders demand returns on their investments in the forms of dividend, which is a cost of equity. So businesses are essentially paying for the privilege of accessing funds, and as they were not using them, they essentially bought back shares. So buying back some of all the outstanding shares can be a simple way to pay off investors and reduce the overall cost of capital. And it can also be a way to make a business look more attractive to investors, because by reducing the total amount of outstanding shares, a company's earnings per share ratio, the EPS ratio, is automatically increased, because now annual earnings are divided by a lower number of outstanding shares. For example, take a company that makes $10 million a year and has 100,000 outstanding shares. This company has an earnings per share ratio of $100. If this company repurchases 10,000 of those shares, reducing the total amount of outstanding shares to 90,000, its earnings per share will increase from 100 to 111.11 without actually never increasing its earnings. So it's a nice way of making the business look more lucrative. What the companies that bought shares back, mainly airlines and cruise companies, never expected a recession coming in the short term, and now have run out of cash to go through the crisis. So in order to strengthen their balance sheets, these companies could have gone to debt markets or equity markets to raise capital. But as demand for liquidity increased in the last couple of weeks or months, so did market conditions. The market now is not the same as it was last year in order to raise capital or take debt. And as a consequence, airlines to go and run to the US government and beg for bailouts to prevent bankruptcy. So now the US government is giving the airlines $25 billion as a bailout, and a good portion of this is structured as a grant, which requires no payback. So this means these companies are given huge loads of money, which a portion is never expected to be paid back, and another portion is given at very, very low interest rates, below 1%. So this means that the Fed has bring money to bail out companies that could have spare cash, but rather decided to repurchase shares. So this doesn't seem so fair. And if the 2008 financial crisis was the worst of all time, how bad is this one? Well, this one is much worse. This time, the US federal government had to print more than $6 trillion to support government bailout packages and stimulus and other initiatives. It's an insane number. $6 trillion it's an insane number, complicated to visualize. It's 6 billion times 1 million. So it's not a number you come across every day. And we were talking about hundreds of billions of dollars in quantitative easing in 2008 and 2009. And today we have already seen multiple trillions of dollars in quantitative easing that have been announced. The problems are exactly the same as in the previous financial crisis, but the magnitude is much worse. This far surpasses the bailouts that were taken in 2008 and 2009. And this explosion of the money supply will inevitably lead to the inflation of the dollar. And not only the dollar, because all the central banks are all over the world are taking the same policies in order to solve the coronavirus crisis. So it's not only the dollar, but it is simply impossible to print trillions of dollars and not see inflation over the long term, which will also drive wealth inequality, the wealth inequality gap to the largest disparity that we have ever seen. Because the secret to inflation is that it makes cash less valuable and other assets more valuable. So most of the rich people benefit from this because they mostly hold assets and keep a small portion of the wealth in cash. But poor people, on the other hand, get completely destroyed by inflation because they have no financial assets other than cash, and they live paycheck to paycheck, so they don't have any financial assets. So this is how the rich end up getting richer and the poor end up getting poorer. This shows how the Fed's balance sheet has grown in the last 15 years. You can see the huge increment in the last that leaves the 2008 financial crisis as a small ant. So how big is this one compared to the 2008? It's way bigger. And if you take a look at the Bitcoin market cap, it's just a small dot out there. So a couple of weeks ago, the Fed was literally printing trillions of dollars out of thin air as monetary stimulus for companies to go through the COVID crisis. And at the same time, Bitcoin was cutting its subsidy rate in half. As you can see, history repeats itself. This has not been it's not the first time in history that we have these kind of problems. And for sure, this won't be the last one as well. So central banks only have two tools at their disposal during economic recessions. And one is the modification of interest rates. And the other one is quantitative easing or QE, which is a fancy word for printing money. And the thing is that once interest rates are low enough, just as they are now, which they are around a quarter of a point or 25 basis points, my memory is not bad, the only option is to print money in an attempt to flood the market with liquidity, because you end up in a liquidity trap, and the manipulation of interest rates at some point just doesn't work. So a couple of weeks ago, a couple of days ago, on May the 11th, which was the day of the halving, something funny happened that was the miners who extracted the last block under Bitcoin's old block subsidy rate, which was at the time 12.5 Bitcoins every 10 minutes, made a small tribute to Satoshi, a message that read very similar to the one Satoshi included in block 0 or the Genesis block. And the message had the same format. It was also the cover of the Times newspaper on April the 9th. And it read as this front cover of the paper, which says, with 2.3 trillion injection, Fed's plan far exceeds its 2008 rescue. So, as you can see, history repeats itself, and this won't be the last time that we will see these kind of things happen. Bitcoin is a hedge against systemic risk and the fight against the virus of fiat currencies. Bitcoin is way more than electronic cash or a payment system. It's the soundest money we have ever seen in history. It's a deflationary store of value, and its immutable protocol guarantees that it will continue to be, because no one in the world, no matter how powerful, can change the rules of the protocol, not the total supply of Bitcoin or the rate at which coins are mined. So fiat currencies, on the other hand, can be put into circulation at the unilateral whim of any central bank. So there is a clear contrast. Bitcoin is a deflationary hard asset that is only getting harder day after day, while fiat money is an inflationary soft asset that is being made softer every day due to central banks' endless printing, in this case to combat the COVID crisis. So relative to fiat, this will inherently drive Bitcoin's price up. It's a simple supply and demand equation, because if the constant or increases, and suddenly supply drops 50%, as it happened a couple of weeks ago with the halving, eventually the price in US dollar terms has to go up. Of course, this doesn't mean that it should occur immediately, because markets don't work this way. But in the medium or in the long run, this shortage of supply and the increasing demand will drive prices much higher than the ones we have today. So if we combine this with all the helicopter money the Fed is throwing at people, we go to even higher prices. At the end of last year, Bitcoin ended up being one of the best performing assets of the decade. By far, there was no asset that got close to this return. So this has led to many people to pay attention to Bitcoin, but also Bitcoin didn't show any statistical correlation to most asset classes, and this gave Bitcoin the property of being declared against traditional markets. So now we are currently in an economic crisis, and Bitcoin is again outperforming every other major asset class. This year it is up almost 25% year to date. So we can say that Bitcoin has served as a good store of value, and that it is an interesting hedge against the current financial crisis. However, many people noted that during the first quarter of 2020, as the coronavirus crisis was ramping up, crypto and traditional markets simultaneously had one of the worst trading days in history. Specifically, it was around March the 12th, or yeah, it was March the 12th. And I want to point out that this does not disprove Bitcoin as an uncorrelated asset, as it is just one small sample, and it is not significant compared to the decade that Bitcoin remains uncorrelated to other major asset classes. So it is also worth noticing that during liquidity crisis, all liquid assets suffer, no matter what their correlation, their historical name was, as people rush to get liquidity and end up selling and liquidating their assets at any price. So I wouldn't consider this year's event as a failure for Bitcoin to remain as an uncorrelated asset, because we should watch the entire data set and not just a small sample. Today, as global financial markets begin to crumble, investors and institutions will try to find safe haven assets. Gold has been a good example historically of a safe asset, and Bitcoin is not yet a traditional safe haven asset, given its very high volatility, but it offers an interesting alternative to gold as a non-correlated store of value during what may be, or what yeah, it actually is the most volatile economic period of the century. So many investors and funds are recognizing this and purchasing Bitcoin as a store of value and as a hedge against inflation. Today, Bitcoin has outperformed this year the major asset class, despite of the crash during March. And one example of what I was mentioning before is Paul Tudor Jones, who is a legendary hedge fund manager, and he disclosed some weeks ago that he's with his fund gaining exposure to Bitcoin. And he stated that the best profit maximizing strategy is to own the fastest horse. And if I am forced to forecast, my bet is it will be Bitcoin. These were his words. So this is something we should be paying attention to. Paul Jones is one of the most successful investors in the world. He has been managing assets for more than 4 decades, and today has more than $40 billion of assets under management. So these kind of investors are stepping in, and we have seen this also in Grayscale, which had a record amount of subscriptions during Q1 of the year from institutional investors. And why are these investors stepping in, and why is one of the most respected in Wall Street betting on Bitcoin? Well, not only for the reasons we mentioned before, but also because Bitcoin is an uncorrelated asset compared to gold, compared to oil, to any stock trading in the US. But basically because it's a very asymmetric bet. And this means the downside is limited to the amount invested, but the upside potential is huge. So this is because as quantitative easing approaches infinity, so does the price of things whose quantity can't be increased. And as you've heard, we are at a moment in which central banks are literally printing trillions of dollars to serve the crisis. And Bitcoin is a scarce good. Bitcoin represents digital scarcity, and its total supply cannot be changed, as well as the rate at which coins are mined. So these are the main reasons why Wall Street is now looking towards Bitcoin, and this is what we communicate and we want people to know, and what we recommend people to store their value if they want to hold value for thinking in terms of years and decades, and not taking a look at the shortest term, because volatility is very high, but year over year the price of Bitcoin has grown. Out of the previous 10 years, in only 2 of them the price decreased, and it was those were 2014 and 2018. So Bitcoin has been a very good compared to all fiat currencies, and the most probable outcome is that it will continue to be, and there's a huge potential for price appreciation still. So this is it, guys. I don't know if is there a chat? Can we? Let me check if there are some questions we can. Am I still online, right? Can you guys hear me? There's a question here. Why hasn't Bitcoin's current price no fully reflective of your argument of a perfect storm? Well, this storm has begun only a couple of weeks or months ago, and we are not out of the woods yet. And this will bring growth for the next years, not for the next weeks or for the next months, because all the helicopter money that is being thrown at people today, a small portion or whatever portion goes to buying assets that can be infinitely replicated, will in the end cause price appreciation. The only thing that is that will get the value and will lose purchasing power is fiat currency. Does anyone else want to ask something? I can't see any other one. Any other question? Okay, well, I'll type my email address. So to stay in touch, we can. I invite you to take a look at our website, which is quantiacapital.com. And well, thanks everyone for joining. Hope you had some fun, and let's stay in touch. Thanks a lot, guys.